I see so many things that could go wrong at this point, and you never know when one of them's going to go wrong. And it seems like that something has got to break, and there's so many candidates for it. So our political system seems to be in a shambles. Our markets are top heavy to a nearly unprecedented level. The absurdity of how they got there, it's not some new era thinking. It's just flat out some sort of inflationary bubble that doesn't even seem to be backed by a good narrative, unlike 2000 when you could pretend like we were entering Brave New World. And now it just looks like dumb money chasing, vast quantities of dumb money chasing dumb investments. So something will crack. I don't know if the election will do it. Something will do it. Don't know what. Butterfly flapping its wings. Who did I hear? Who was it who said it? Maybe Singer said what people don't understand is the pain and suffering caused by duration, which he means time, which you say, well, that's duration. But, the bond market has its own duration sort of meanings and stuff. But this is what I've been predicting for quite a while now, that time is your worst enemy. During a bull market, time is your friend. I think when the next bear shows up, unlike previous bears where they've spent some period of time, which I consider brief, heading downward before they start heading back up without fail. I think that's a 40-year bias that's come from the fact that for 40 years, Fed policy has been loosening, interest rates have been dropping, demographics have been favorable. China's been providing cheap labor, Russia's providing commodities, all of which look like they're at the end of their rope. So I think the next couple of decades, we're going to have to grind it out slowly, and it's going to be a painful period in which economics may be fine, but I think the markets will basically do a lot of up and down and a whole lot more going nowhere. And I don't think people are ready for that, which is exactly the setup, actually. When people are not ready for it, that's what happens. So I'm just kind of waiting. Time is my enemy right now because although the markets are absurdly priced, those of us patiently waiting to buy assets at a fair price are kind of out of the game. So we're not getting to play, and I wouldn't short the thing. So I don't know what you do besides just sit on your hands and recognize that there's never in the history of markets been an overvalued market that didn't eventually find its way to undervalued. And so you start doing the arithmetic, and it's simple math. Once you lay out the valuations, you go from overvalued to undervalued. It is a very, very negative track. It's not a 20% correction. It's not even close. So that one was part of what became a pretty serious inflationary impulse. And so this idea that there's no free lunch, there really has been a relatively free lunch for 40 years, dropping rates for 40 years. And so and we've had the disinflationary effect of China, which I briefly hit upon. And so I think those are over. And as a consequence of that, I think that the era of the V bounce is over. I think the idea that every dip should be bought, every bear market will lead to a much better bull market. I really think that those days are over. I don't know when it's going to start. I mean, we could double from here for all I know, although I'll be shocked, but it wouldn't be the first time. So I am the most bearish person I know. It'll depend on if I'm right about the Fed and central banks being boxed in by inflation. So if we really have run out of runway, and that any effort to print our way out of a mess, which sounds so absurd when you say it, that you go, how can that possibly be, without a price? And the price is inflation. And what you now realize that a lot of people didn't realize until 2 or 3 years ago is that the inflationary price is not painless. I remember on Twitter, people would say, well, they'll just print it away. And I go, you're going to get crushed when they do that. You're going to get annihilated. So let's say the U.S. debt is got to be cut in half by some inflationary impulse. The spending power of everything you own is going to be cut in half. That's the same as losing half your money. It doesn't matter how they do it. So, and our unfunded liabilities are in the 250 trillion category, of which 175 of those 250 trillion are just Social Security and Medicare, I think. And I actually had a discussion with a hedge fund manager who challenged that. And then I sent him a treasury report, and right there in page 294, table whatever, was a line that said this is the unfunded liabilities for Social Security and Medicare, which are defined as things that you've promised that you have no idea how you're going to pay for, even after you project revenues going forward to infinity. And therefore the answer is, well, what happens? You go, well, this is like being told you have stage 4 liver cancer. And you go, well, what are we doing? You get your affairs in order. So you have all these people who are now expecting to consume their asses off and more work and do no more work. They talk about how the economy is a 70% consumption economy. I go, that's not an economy. And what is kind of a stupid definition of that? An economy is where you produce stuff, and then because you produce something, you get to consume. So someone's got to grow the food, make the stuff, do all the things you do. It is through that wealth creation process that you then get to consume. And if you don't grow the food, you don't get to eat. And so to say it's 70% consumption is really saying it's 70% borrowing at some level, right? Because really the economy should be production, gross domestic product. And we're going to start counting healthcare costs as GDP and stuff. We already do, of course. But the boomers are going to create a huge amount of GDP as it gets counted by getting sick, by getting their bladder stones taken out, getting their prostates taken out, and getting their teeth fixed, and all the things that old folks do. There's nothing about that being a product. And that is, if you think, yes, it is, you're benefiting from it. And I go, no. Imagine hypothetically that you weren't sick, that you weren't obese, that you didn't have a bladder problem. Wouldn't you be better off? To call healthcare product, I think, is flawed. And so what gross domestic product healthcare division is really about is the cost of a rapidly depreciating asset, which is what we call boomers. So, and it's going to be a lot of money, and they're not producing anything. And the younger generations, which are smaller, less productive, in my opinion, less motivated, in my opinion, are either going to have to work harder or the boomers are going to have to get less. It's going to be one of the two. And that's actually in some sense a plus, because that means you're producing something. If the boomers keep working, that is product, right? And if you think of the olden days, you eat what you kill. And as a consequence, if you stopped doing something, if you stopped being functional, you died. I think we're heading for multi-generational housing again. Part of it's because the boomers have big houses, they don't know who to sell them to. And we are told, and I'm confident it's true, the next generations coming up don't have the money to buy them at the price we want, right? At the assessed price. Mortgage, the cost of buying a house now has doubled. So either pay half as much for the house or pay twice as much of your salary for the house. That's not going to happen. I also don't think the younger generation wants big McMansions. I think there's a problem there. I think that they've been raised to think green and small footprint and things like that. And I collect American antique furniture. The younger generation likes chrome. They like the nouveau tech. And so there's no reason to believe that the younger generation also wants to own a 6-bedroom McMansion for a 3.8 member family. That has not been wired into their DNA, I think. So I think we'll have multi-generational housing. And what did that do? Well, in the olden days, it turns out while the parents were in the fields and hunting and doing things that parents did in the old days, the grandparents watched the kids. They cooked the meals. They did the work around the house. And it provided daycare facility, so it saved on daycare. It provided a way to take care of the grandparents as they got older without a huge added cost. And so I think we're going to head back to that. At first, it'll feel like a failure, right? You hear about the kids living in the basement and what a disaster that is. Someone referred to the basement as the modern day opium den. I think it was Adam Taggart. But at some point, we're going to go back to the sort of addition on the side of the house where grandma lives. And that way you don't have to spend money on a nursing home and stuff like that. And I think it will get more efficient. And so you'll see stuff like that. We'll adjust, but one's got to hope that we can gracefully, gradually get to this without catastrophic events taking us there the hard way, right? If you want to decelerate your car from doing 70 miles per hour, you'd rather tap the brakes than hit the bridge. It's election year, so a lot of the statistics are corrupted by the fact that they're reporting good jobs numbers and then revising previous month's job numbers. And so, as I said to Stephanie Pomboy one day, sort of semi-privately, I say semi because now I'm telling you the story. I said, watch the little stuff. Don't look at federal employment numbers. Find a way to look at local employment numbers. Find a way to look at state employment numbers. You want to look at economic metrics that are too small for the people who like to rig the numbers to make them look good. Bother. So if you can get a read on what's going on in some industry that tells you about economic information that flies in the face of the favorable economic numbers during an election year, then you'll get a better read. It has more economic information in them. And they all look to me like they're rolling over. Everything looks like it's rolling over except for the stock market. There's all sorts of fallacies out there that of the type that if you just are paying attention, you go, wait a minute, that isn't even true. So, people talk about how low interest rates are bullish. That turns out to be wrong. Turns out dropping interest rates are bullish. Low rates are not. You've already squeezed the juice out of that orange. And so rates drop from 16 to 0 over a 40-year period, and that was bullish. Once you get to 0, you're done. You've got no more tailwind from those rates. And then you see people who are talking about how it's going to be great, as soon as Fed starts dropping rates, dropping Fed funds rates. There's a short-term window now. Then the market's going to take off. And it sounds like a contradiction of my own statement, but the short-term stuff is just white noise. But if you look at the last two major downturns, the 08-09 and the 2000 to 2003 downturn, the day that the Fed started dropping the rates was essentially the same day that the markets topped. So the guys who say, look, as soon as this Fed starts dropping the rates, we're just going to soar, are ignoring facts. They're ignoring the fact that that's exactly wrong. And usually the markets bottom. And again, this is the age of the V-bounce. So I'm not even sure they're going to bottom the same way next time, but I'm not sure they're going to bounce off the bottom. But if the Fed start dropping rates, the last two major downturns tell you you're about to lose at least 50% of market cap. And it's going to follow the rates down. The market cap drop is going to follow the rates down. All you have to do is look at a plot of the Fed funds rate superimposed upon the S&P 500. And the drop, the beginning of the rate dropping cycle is the beginning of the bear market. And so I don't see how many people who think they're watching these markets carefully could possibly think to the contrary. It's mystifying to me. I think that means it'll be an even rougher ride down, because the longer the duration problem, as debts are rolling over and people are rolling from a 2% interest rate to a 5 or 6 or 7 or whatever, your profit margins are going to go to hell in a handbasket if you're a company. So companies borrow tons of money, and now they have to roll over that debt. And as their profit margins drop, then they can't pay off the debt. There's this odd irony, right? When they need twice as many profits to pay off the debt, they have half as many profits. Everyone's talking about the Fed should be cutting rates. I'm going, no, let us hit a wall. I just don't agree with that, actually. I think just, the Fed said it was going to hurt. They were going to cause, Powell used the word pain 3 times. Someone explained to me where the pain is besides the pain of inflation, right? There is some pain out there, but it's not the kind of pain you get in real butt-kicking recessions. We don't have that kind of pain yet. I think Powell wants good job numbers. I think he wants to wring some of the crap out of the system as much as he can before all of a sudden there's a crisis and he has to respond. So I think he intends to stay, high for longer. And this isn't even high. What are the rates at 5% or something? If you'd told me the rates would be 5%, I'd say, holy shit, what drove them down to 5%? 5% was ridiculous for most of my life.